Hey, the mortgage class, it's Phil McDowell, the mortgage professor, coming to you again. And yesterday I was asked the question from CBC Radio. Now that interest rates have gone up by 0.25% on the prime lending rate, is it now the time? Do I have to lock in? What do I do? Well, a lot of people are fence sitting on keeping their variable rate going to fixed term. Now, what I said on CBC Radio was there is usually a very big gap between a variable rate mortgage and a fixed rate mortgage right now. For example, the very best mortgage rates that you're getting running at about 4.5% on a 5-year fixed. Now, even with a bump up of 0.25% on prime lending rate for most banks was at 2.25, now 2.5. Lots of times you're getting a discount of 0.5%, so even now that variable rate is at 2%. That's a big gap between the variable rate and the fixed rate. So some people are saying, okay, the chances of interest rates going up by more than 2%, 2.5%, 3%, 4%, 5%, remote. I'm not worried, I'm staying with my variable, go away, don't bother me. Other people are quite bothered by it, and they'll just can't get any sleep at night, saying, holy smokes, if rates really go up, can I really afford this mortgage? I better lock in. That's my peace of mind. Let me make a decision. I'll look at it again in 5 years. And if that is the way your temperament is, then that is the best decision for you. But there's also financial institutions that says, hey, if you can't make up your mind, you don't have to. What we'll do is allow you within your mortgage is to piecemeal various terms so that no matter what happens, you've got an opportunity to change up in the future somewhat. So I'll give you an example. I've done a mortgage here where your whole mortgage is set up and a portion is going to a fixed 1-year term. A portion is going to a fixed 3-year term, a portion is a fixed 5-year term, and then the balance is in a variable rate. Now, the theory behind this is a year from now, you won't know what the interest rates are, but a portion of your money will come due, at which time, if you're keeping with the same strategy, you'll just renew this portion for another year, whatever the rates are. In the meantime, whatever variable rates are doing, you're affected by it. If they go down, you won. If you go up, you lose a little bit. But a lot of your money is still in fixed term. So that's the safety valve for you in case rates are really going up. Now, 3-year term, 5-year term. Now, the only danger with this kind of mortgage is it is really only one mortgage. So if you're staying with this theory, when this rate comes up, bang, you're going to renew it. At what interest rate? At what interest rate? Because you're locked in for 5, you're locked in for 3, 5, and the variable rate. All of this money is subject to a penalty if you don't like what they offer you for your 1-year term for that portion of money. You've effectively lost your negotiating power, because if you don't like the 1-year term, you can't just say, well, listen, I'm going to go to another financial institution and get a better 1-year term. The lender is going to say, aha, it's one mortgage. You've got a 3-year and a 5-year and a variable. If you want to change this, you got to change it all. Penalty, penalty, penalty. So if you are looking for a hybrid where you can't make a decision between variable and fixed, and you're offered something like this, maybe it is good for you. But keep in mind, when this term comes due and when this term comes due, you have no negotiating power. You can't transfer pieces of those mortgages out to another lender willing to give you a better rate. So the cautionary is, know that you're going to have no negotiation here, and when this 3-year comes up, don't renew for 3 years again. Renew for 2. Why? Because eventually you want your mortgages all coming due at the same time, because eventually you'll want to be in the driver's seat to negotiate your rates. Here, you gave up driving. Watch your money.